If you are under age 40 and saving to become financially independent, the ultimate strategy for you could be lifecycle investing. Essentially, you borrow in your first decade of investing and invest 100% in stocks. You slowly pay off the leverage by your early 50s, and then you start adding bonds, moving to your desired mix by retirement. Compared to traditional methods, a Yale study proved it increased portfolios at retirement 100% of the time in the last 150 years, and by an average of 63%. The results are so consistent because it reduces one of your biggest financial risks, the so-called last decade risk, by diversifying across time. The traditional way of investing money bit by bit creates a big last decade risk, because 80% of the investments you own over your working life are usually after age 50. If your last decade of a 40-year working career has a low return, like 2000 to 2009, your retirement income is reduced by more than 50%. It is best to think of life cycle investing as a concept. Save for your retirement the same way you buy your home, a huge loan to buy it that you pay off over time. If you want to implement life cycle investing, it is best to create a financial plan first to decide how to do it over your lifetime. The right strategy for you might be large, small, or no leverage, but it is far more effective to do it as part of your financial plan. Most investors between 30 and 40 years old believe that the most important part of their future retirement is the rate of return they get on their investments. This often leads them to ignore financial planning and just focus on investments. The rate of return you have before age 50 is not that important because it is on a relatively small amount of money. To be clear, borrowing to invest is a risky strategy and is not for everyone. If you may make the big mistake selling or investing more conservatively after a crash, or if you chase performance, then borrowing to invest is probably not the right strategy for you. Borrowing to invest should always be a long-term strategy to increase your odds of success. A suggested minimum is 20 years. For a complete discussion of lifecycle investing, go to the must-read section.